Welcome back to Stock Trader School, from rookie to Rainmaker, and this is Wall Street Walkthrough. We break down how investment banks make money. Let's dig in. Now, before we get into it, there's this popular meme floating around the internet that summarizes the relationship between investment banks and everyone else. This is obviously a caricature. And while it might be funny to think of bankers as these all-powerful puppet masters who pull the strings from their fancy offices in the sky, it's not totally accurate. That being said, they do have a pretty outsized influence on capital markets and on the companies and economies around them. Now, if you want to learn more about how investment banks actually work, we highly recommend checking out our series on the bulge bracket banks or our most recent video on boutique investment banks. Both are linked below, but for now, let's answer the question: how do they make money? Companies will pay investment banks for advice on mergers and acquisitions, divestitures, restructurings, recapitalizations, bankruptcies, and other situations that require specialized knowledge of capital markets. Of all the advisory services, M&A is probably the most well-known. It's been portrayed countless times in movies and on TV. This is when investment banks trade for their own account rather than for their clients. You might hear prop trading referred to as principal trading or, my favorite, arch trading. This ratio is a percentage of a bank's total assets and is designed to ensure that banks have enough capital to cover any potential losses. One of the biggest costs associated with prop trading is the risk to a bank's reputation. However, trading is just one slice of the pie when it comes to how these banks make money. In fact, compared to the rest of their activities, trading is relatively small. While prop trading is a significant part of an investment bank's business, it does come with risks and costs that must be carefully considered. By understanding these risks and taking steps to mitigate them, banks can help ensure that they are able to continue providing valuable services to their clients while also protecting their own reputations. Even if a bank is taking steps to mitigate risk, such as maintaining high capital adequacy ratios, there is always the possibility that something could go wrong. For example, if a bank suffers a major loss on a prop trade, it could damage the bank's reputation and lead to a loss of customer trust. This could have serious consequences for the bank, including reduced profits and even bankruptcy. That's why many banks have implemented measures to protect their reputation, such as setting limits on the amount of risk that can be taken on and creating independent risk management teams. The higher the ratio, the more capital a bank is required to hold, which in turn reduces the amount of risk they can take on. Regulators regularly monitor banks' capital adequacy ratios and may require banks to increase their ratios during times of economic uncertainty or stress. This is the stuff that gives investment banks a bit of a bad rap, since prop trading is largely responsible for the 2008 financial crisis. While prop trading is generally separated from the client-facing businesses, banks can still use client trades to inform their own positions. For example, let's say a bank is acting as an underwriter for a company's IPO. In this role, the bank will want to know what the demand for the stock is like from potential investors. They can gauge interest by placing their own order for a certain number of shares. This way, the bank can see how much demand there is for the stock before the IPO and adjust accordingly. It's a way for them to get a sense of the market and make sure they're pricing the IPO at the right level. A big part of an M&A banker's job is to convince a large corporation that wants to buy another company that the purchase is a good idea, and then help them execute it. Prop traders usually take on a lot of risk, which means that if their baits don't pay off, they could lose a lot of money. In fact, in 2015, Deutsche Bank famously lost $5.8 billion on a bad trade, which led to a major scandal and a loss of market share. That's why prop trading is heavily regulated, in order to minimize the risk of big losses that could threaten the bank's stability. Regulators want to make sure that banks aren't taking on too much risk with customer money or putting themselves in a position where they couldn't pay back their debts. If you watch Billions on Showtime, you'll see that M&A bankers live the most exciting lives out of all the bankers, except maybe for the distressed debt traders. But really, advisory work covers a lot more than just M&A. Restructurings, for example, are another major focus. Think of a company that takes on too much debt and needs help restructuring it to stay afloat. Recapitalizations, which is when a company changes its capital structure, say by taking on more equity investors. Divestitures, which is when a company sells off a portion of itself, and bankruptcies, which is when a company has taken on more debt than it can handle and is unable to repay its loans. All of these transactions require navigating complex legal and financial issues, which is why companies often turn to investment banks for help. These advisory services typically involve a lot of time and effort upfront, with long hours and high leverage. If the deal gets done, investment banks typically get paid a success fee. In the case of M&A, the fee is usually a percentage of the transaction size. For example, if two companies merge for $100 billion, the bank might get $150 million in fees. However, not all deals close, and some can take years to complete. So the banks need to be prepared to spend a lot of time and money upfront, with no guarantee of success. So overall, there are two ways investment banks make money: through fee-based activities and through proprietary trading. Banks invest this money according to the needs and goals of the client. So it's important to note that asset managers don't trade with client money. They simply invest it based on the client's preferences. For example, an asset manager might invest a pension fund's money in a diversified portfolio of stocks and bonds to meet its long-term obligations to retirees. Or they might help an individual create a portfolio that aligns with their risk tolerance and investment goals. To put it simply, asset management is about helping clients grow and protect their wealth over the long term. But fear not, we're going to break down both of these in simple terms and also share some interesting insights about each bank and each business line. And sure, trading is a huge part of what investment banks do, but it's only one sliver of how they make money. In fact, compared to the rest of their activities, trading is relatively small. So let's start with fees. When you think of investment banks, you probably picture trading desks filled with people yelling at each other and making wild hand movements. Broadly speaking, there are three main types of fee-based businesses: underwriting, advisory services, and asset management. Underwriting refers to helping companies raise capital through things like IPOs, debt offerings, and equity offerings. When a company wants to go public, they hire an investment bank to help them set a price for their stock and then sell it to the public. They also help with smaller equity offerings down the line, like follow-ons. Similarly, when a company wants to take out a loan, they'll turn to an investment bank to help them set the terms of the deal and then market it to investors. Debt offerings can be for all sorts of different reasons, whether it's to fund day-to-day operations, acquire another company, or refinance existing debt. These are all things that are relatively rare, so when they happen, they tend to pay big. The biggest IPO in history was Saudi Aramco at $2.7 billion. And the biggest debt offering ever was the 2009 $42 billion bailout of Chrysler by the US government. Naturally, given how big these deals can be, investment banks compete fiercely for the right to underwrite them. For example, when General Motors filed for an IPO in 2010, rumors suggested that the banks were bidding against each other with promises of golf outings and private jet rides to win GM's business. The second big source of fees comes from advisory services, which is basically what it sounds like. The last piece of fee income comes from asset management, where investment banks manage money on behalf of clients like pension funds, endowments, and individuals. Now let's talk about prop trading, which is Latin for proprietary trading. Prop trading involves taking a position on a security and then hoping that the price moves in your favor before you sell the position. To mitigate risk, regulators require banks to maintain a certain amount of capital on hand at all times, known as a capital adequacy ratio. As we discussed earlier, investment banks offer a wide range of financial services, including underwriting, advisory services, and asset management, as well as prop trading. All right, everyone, thank you so much for joining us on this episode of No More, Ask More. Now you know what really funds the street. See you next Wednesday for another Inside Look.